This is Satya Pradyuman of Cirrus Research. I want to call your attention to our latest issue of the briefing report. The briefing is a monthly market wrap looking at market patterns, performance, comparing it to prior periods, and also tying it into our house views. In this in this title, equity markets strong in 2021, COVID on, COVID off undercurrents remain the narrative. And really that was the heart of it, which is that we've continued for 2 years now to see these trends between, lockdown stocks and reopening stocks come back to life. The knock-on effects of that would be rates starting to back up as you get into yet another reopening, as we call it, yarrow. This chart, which made the cover, I thought was super, super interesting. It caught a lot of us off guard. The fact that you had this massive gap of performance between the small cap market and the large cap market. Very dramatic stuff, right? So for instance, the beginning of the year was very pro small cap. The back half of the year, this bottom panel shows you that small caps, the purple line here shows you that it gave up close to 20% relative performance to the S&P. But what was super interesting is this top panel, where what we had was value in the small cap market. The purple line represents the Russell 2000 value to growth. And what that relates is that there was a good 20% outperformance in value over growth. In fact, the growth index in the Russell 2000 was up only 2% or so, whereas the value index was up 20 some odd percent. Here's something interesting though. This gap was massive when you look at it versus the large cap variation. In other words, in large caps, value lost ground. And so this spread is pretty meaningful. We're looking at a 20% gap in 12 months. And the question is, what's going on here? To some degree, as best as I see it, it looks as if the market's transitioning. The market is transitioning to higher quality. We'll talk a little bit about that in a second. So what occurred was that speculative growth was sold down, and that really hit the small cap market and the growth segment. Growth in the large cap area is visible quality mega cap. It didn't really break. And so this gap is something that we're going to have to watch. I think we're still in the throes of this. I don't think this changes. As we've done, I think we've been fairly vocal to say that innovation stocks will remain under pressure as you get a reopening and therefore rate risk. This is another curve, the updated COVID data. We still keep going through this with this latest strain. And really the way the year began was to really react to the peaking, hopefully the peaking of this latest Omicron strain. So we think that the rate risk we're living right through now is exactly a reaction to the possibility that the system starts to reopen. This other chart represents the quality curves, and this is going back a few years, but these lines, they represent just about every flavor of quality. You could look at ROE, you look at leverage, you could look at credit quality. They're telling us one thing, which is for a couple of years, higher quality stocks have really been penalized. In the last 6-9 months or so, they're starting to recover. And the bottom line here is that as the profit cycle matures, we think this will likely continue. One theme we've really focused in on is this idea about infrastructure. What we're seeing is this, as much as the investors are sort of stuck right now on, COVID off, tapering on, tapering off, what we've seen in the last few months is a remarkable pickup in infrastructure performance. We think that there's more to this. There's some fundamental data that really supports this. This work, these series represents the Cirrus infrastructure series. We created 3 baskets, small, mid, and large. And with that, we think this will be very important in 22. And then finally, when you look at drivers of performance, it looks as if business momentum in the large cap area was dominant, followed marginally by quality, and value, as I said earlier, just did not add value. In the small cap area, most of these pillars worked. There was a very good active management moment for small caps. What's important here, though, is it looks like business momentum and undervalued factors really worked, and so did quality. So it was a really interesting year. It's pretty wild how strong the numbers were, considering how violent the undercurrents were. And with that, feel free to reach out to us for any questions. Thank you.